Monica, how you doing, Dima? You're on mute,
Good
buddy.
morning, Will. How are you? I had
Awesome.
myself on mute.
Awesome. The disclaimer's up. Why don't we jump right to the disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers, and we're not telling you what to do. If you need professional advice, call your broker. That's what they're there for, to help answer your questions and provide you with guidance. There's the disclaimer.
Excellent.
And we will get started.
What's moving on the pre-market?
Yep. So we'll start out with the pre-market. I'm going to go up here to the pre-market report. And I think then we'll move on to screening for option straddles. So here, and if you guys have any questions, you can post them on that YouTube chat. Will's monitoring them. He'll read them back to me. If you want to ask your question directly, we're also putting out a link there to Zoom. If you click on that link, go over to Zoom, raise your hand. You'll be able to ask your question live. You don't need to turn on your video camera, but just turn on your audio. So those are two ways you could ask questions.
Yeah, and just so everyone knows, you're allowed to click on. We had a question yesterday. Someone wanted to come over to the Zoom and not ask a question. You can watch from that link, and that link is pretty much the same every day. You can come over and to the Zoom to watch the show if you want. Sometimes the YouTube is a little blurry on some people's computers for whatever reason. The Zoom is always crisp. So there you go.
All right. Yep. Awesome. Thanks, Will. So let's start out with the stocks that are trading in the pre-market hours. So we have our most active list, biggest percentage gainers, biggest percentage decliners. I'm coming down here. I see 104 stocks made our percentage gainers list, 56 on a percentage decliners list. So from that standpoint, it looks like a more bullish bias at the open. Let's take a look at the S&P 500 stocks to just compare if we see a similar situation. I'm coming up here to use the filters. I'm dropping this filter out down in ETF. So I'm going to select the SPY ETF. This is S&P 500 ETF, and this will filter the list below by the components of the SPY. Here we see 15 made our percentage gainers list, 4 on the percentage decliners. So still bullish bias at the open, but the lists aren't that big, right? So we don't have that many stocks. I think yesterday we had a lot more, but nevertheless, a bullish bias.
It's interesting. You look at that list once you sort it by the SPY, and it's all the travel stocks, and the airline stocks. People getting out. Obviously there was good news about the booster shot today and the new variant, how effective it is. So
so you've seen a big what is, like, I just scanning with my eyes, I'm noticing you got cruise ships on there, airlines on there.
Expedia, the travel site, Win the game. The casino company,
travel site on there. So we're seeing a lot of
Las
at least
Vegas
in the morning
there.
In the morning, these travel leisure stocks in there. We'll see if that continues. But they've been very volatile, and I think that they've been getting hit. As well. At the same time, we do have oil prices going up, and we got I don't know if you try to price out, Will, and going on vacation now, but it's not, you're not getting great deals. At least I was looking at, taking a trip to Miami, and it definitely was, the prices that I was looking at wasn't expecting, what I saw.
That's interesting.
It's So
I mean, I just clicked up a couple of the tickers, the casino stocks, and I mean they are near their 52-week low, which is because I know they had a big run when the vaccine started to roll out and people started getting out of their houses. They've really come all the way back almost.
Yeah. Well, look, I mean, they're going to be, if anything happens again with this coronavirus new strain, if we see an uptick, they're going to be the first ones to get shut down, right? So I think they're There
Yeah, no, that's the new paradigm, right? No one ever thought their business could literally be shut. Well, not in this life.
Yeah.
No one thought their business could just be shut, right? And it happened, and now that's a risk for anyone in the space of starting a business. It can literally be shut overnight.
Yeah,
which is
for safety reasons, they'll just shut it down, and
a whole new dynamic.
Yeah, so over time, maybe that risk premium will get priced in appropriately. But let's move on then to the strat. Unless you have questions, Will, popping in.
No questions have popped up yet, D.
All right, I'm going to come up here to the screeners, and we have scans for different types of option strategies. I'm going to use this straddles, and the straddles really for options. You're buying. It's a non-directional option strategy, and what I mean by that is that the strategy is set up in a way you're buying a call, you're buying a put, or you're selling a call, you're selling a put, and it shouldn't have a direction that you want the stock to necessarily move up or down, but you're looking at the volatility of the stock or the magnitude of the move. So if you think that option premiums are very expensive and they're so expensive that the stock is not going to move enough to cover those option premiums, then you're a seller of options. Or if you think that the stock has a potential to have very explosive volatility in either direction, up or down, then you're going to be a buyer of premium or buyer of options. And maybe, before we do a screen, and things to look for, maybe let's just take a look at a payout diagram of what an option straddle looks like. This way we get a visual here. So I'm on Apple. I'm going to go to the options chain, and let's set it up. I'll come out here. Let's say January 14th. All right. So got 27 days to go on this expiration. And if I buy call, right? So here, this the option should be, this is the call. The call's on the left-hand side, puts on the right-hand side. And let's just take a look at a strike that's near the stock price. So stock closed 171. The closest one, let's just say, is 170. So if I buy the call, all right, let's just take a look at that. If I'm just buying the call, I'm going to show you a payout diagram here. I need the stock really, and I do nothing else. I want the stock to move higher, because if it just sits here, I'll lose that premium, right? If it goes down, obviously, then if it closes below the strike, that option will be worthless at expiration. I lose the entire premium, and it has to really increase by enough to cover the cost at expiration, enough to cover the cost of that option above the strike price for me to break even, and then above that, it starts to be profit, right? So that's a call. Put will look the other way. But what if I do both? I buy the call and I buy the put. So now I'm buying both. Buying the call, buying the put. So you see here, I have it set up on the same strike, 170 call, 170 put. I'm going to load that strategy now. So the cost of that strategy, right, it's going to be the cost of the call plus the cost of the put, right? I got it because I paid for both of them. So here you go. Paying the offer will be $12.75. Okay, and there's the market. This is the bid, the offer, the midpoint. So if I'm buying both, what's important now? Well, if the stock just closes at 170, then and both of these options expire worthless, then I lost the entire premium that I paid for both options, right? If the stock starts moving away from 170 to the upside, the call will be in the money, the put will be out of the money, call will be in the money. So, you get that difference between the strike price and the stock price, but it's got to move from 170. It's got to move enough to cover this cost, $12.75. And then after that, the more the call goes up, that's when it becomes profitable, just like, one for one with the stock. What about to the downside? Well, if I paid $12.75, if the stock's moving down, the call will be worthless at expiration. The put will start having value below 170, but it's got to move by enough to cover the cost of both the call and the put, and then it starts making profit on the way down once it covers that amount. All right. So this is the straddle. So you could see here, doesn't matter, if the stock moves up or down, really, it's the magnitude of the move, right? Is Apple, likely in the next 27 business days, is it likely to move by more than $12.75 to the upside or the downside? And, that's kind of what the question is. And that will basically determine your decision. Should I be on the buy side, sell side, or is it kind of fairly priced? So that's what the straddle looks like. And when we look to screen for the straddles, we kind of want to see, well, where are the straddles we think are relatively cheap, or the premiums are relatively low, or maybe where the premiums are relatively high. And then we'll take a further look. Okay. So that's the visual in the straddle. Let me know if you have any questions, Will.
I will.
All right. And the thing is also that for every expiration, the straddle price will be different, right? So the more days you have to go, the more the straddle will cost you, because you have more time for the stock to move, right? So the more time you have for the stock to move, the more chance it moves further and further away, the higher the premium for those options. So I just showed you one expiration. The screener will help us kind of detect, and narrow things down. So let's go back to the straddle screener. And on the straddle screener, a couple things down here. I think the first thing is there is a default filter here, and it goes to the next monthly expiration. But let's just look at any expiration within the next 30 days. So you could see here there are different expirations here: December 8th, December 10th, 13th, 15th, 17th. So let's do anything that expires within the next 30 days. So now I got a mix of different expirations in here. I got, see here, December 23rd, January 7th, 31st, and so on. So now I got a bunch of different expirations on here.
Hey, D, as you're going through the next straddle, Jeff is asking, does anything happen to the value of the straddle if the IV changes?
Yeah, of course. That's what if the implied that's what determines the premium, right? The time premium of that straddle is the implied volatility. So if implied volatility is going up, the option premium is going up. That's what the implied volatility, you're working backwards, right? You're taking the option premium and saying, well, what is this implied volatility? But yeah, of course, that's really the time premium, right? So option premiums go up, implied volatility is going up. Option premiums are coming down, implied volatility is going down. So for sure, the implied volatility is a big factor in that options premium. Because the straddle itself, if you're a true straddle that's exactly at the money, it's all time premium, right? There's really, if you buy a straddle which is exactly at the strike price, those are the options with the most time premium, right? And that means there's no real intrinsic value. You need the stock to move. Hopefully that's making sense. Perfect. So we'll take a look at that, the implied volatility, and we'll compare it also to like a historical benchmarks. So I did change this filter, the expiration. And I'm going to kind of go through just, we do have below the data, and we have different data tables. When you scroll like this, I'm going to just concentrate on the summary table. And we see here, this is the option symbol, the stock symbol. So Apple, AAPL. And you can see Apple came up a bunch of times because they're different expirations, right? And this table itself is sorted by default by market cap. So if you click on any of these, it'll resort it by these columns. So Apple, this is Apple's stock price, what Apple did on the day, and its market cap. And then we go into the details of the straddle. And so here's the straddle. This is the actual straddle. And we get one from the sell side, one from the buy side. And this is the expiration, December 23rd. This is the strike we're looking at, 170, right? So we don't have an exact 171 strike, so we're finding the strike price that's the closest to the stock price. And from the sales, why do we look at sell side, buy side? Well, when I showed you that straddle, when we did the payout diagram, right, you have one price that the market is displaying a bid, and then you have another price that the market is displaying an offer and ask. So you have kind of two prices there to look at. So if I'm selling it on the bid, right, if I'm selling it on the bid, which would be theoretically, my worst execution price at that moment, because I'm getting an immediate, I'm not trying to do a limit price in between. Then how does that compare to what we think the straddle is worth? And if you're buying it, well, we're examining it from, if you're just buying it right on the offer, getting an immediate execution. So that's how we're going to take a look at this. And let's just do it from, let's start it from the buy side. So I'm going to use this filter, and I'm just going to look at straddles from the buy side. Okay. And so now we talked about these. So here are the stats on the straddle. So in Apple, this January 7th expiration, if we're approaching it from the buy side, the market price we would be paying is $11.30. And we kind of have to figure out, okay, since we're screening for it, we need a benchmark. Is this a relatively high price, low price, fair price? We kind of need to try to make that estimate, right, to help with our screen. And to do that, we take a look at the historical value, historical stock behavior of Apple. Say, okay, we know January 7th, we know how many days are left. And this is the analysis, right? So this is the analysis of the straddle. Let me put it right up to this. And we could see that how many days are left, 22 days to expiration, where the stock price is. And we could take a look at historical values to approximate what this straddle is worth. So I'm not going to go just to save time because I'm running out of time. What we're saying is based on historical stock behavior, the theoretical value on average it's worth $13.04. Okay, so if we look at how the stock moved up and down and within that period, within that given that space of period, and we also looked at historical data if there was no earnings, we looked at historical data without earnings and so forth. How much did that move around? And then we get an average end value, and then we could compare that to the market price and see, well, is there a difference, right, from the average to the market price, and how much is that difference? And that's kind of like the theoretical edge, or like the extra you're getting, below that theoretical value, right? So that's what this is here, and we could screen by that, right? So we could screen by theoretical values. Over here, theoretical edge, right? So I could set that, above 10%. So win rate, that's just saying, well, how often did Apple, if historically we looked at $11.30, we converted all into percentages in the background. How often did it move enough to cover that cost? That's 60% of the time. So right now, got relatively cheap. And here we have a couple more stats. This is the implied volatility of that straddle, and this is the implied move. So it has to move about 6.5%. It has to move 6.5% in either direction. That's the break even. Above that, you start making money. So I could just click on there, take a look at it. So it sets it up, and here's that straddle. And we're looking at the historical distribution. So this is the straddle we're talking about, right? 1130, midpoint 1120. This is what it looks like at expiration. And there are a couple different ways we could start now analyzing it, right? So we kind of saw, okay, this kind of looks cheap to us. Let's take a closer look at it. And the first thing we could do is look at the distribution. And this is how the stock historically moved, right? So if we take 4 years of data, right? We take 4 years of data and we say, well, if we, in the last 4 years, if we took 22 trading days, right? So we kept going back 22 trading days and looked at from the start to the finish, how much did Apple move over a 22-day period? We took that in percentage terms and then applied it here. We would say that this straddle, the straddle on average would be worth $13, right? So that's looking historically, 22 days. There are 28 total observations. It's excluding earnings because Apple's not expected to report earnings. And this is the historical average end value, okay? And this is the historical win rate. So let's take a look now at the implied volatility. So that's how the stock moved. What about how the market tended to price these options? So I'm going to the IV here, and here we see that this here is looking at similar situation. Well, if we exclude our earnings periods, how did a similar option, right, with 22 trading days left, what was the implied volatility? So we're taking historical snapshots and converting it to what the options would be worth today. So you could see here, these would be the historical theoretical values. And if we take the average, we're looking at $11.09. So from the implied volatility standpoint, we're probably paying a little bit over. Okay. So those are the things you want to look at. Well, how low can the implied vols come in? And we could see here that we're paying a little bit over if we look at that metric alone, and we could see the range. So $13.40, $9.14. So we're kind of like in between them, right? Or in between the low and high range. We could see here, how this option recently moved around. So that's two ways kind of looking at it, right? There's no one way to analyze it. There are different perspectives, different angles to analyze it. One is, well, how does the stock usually tend to move? Are these options look relatively cheap or expensive? And how do the option premiums, the implied volatility, tend to price the straddle, right? Because the implied vols maybe tend to price it a little bit higher than the historical volatility, or a little bit lower. So we're looking at from both perspectives. Does that make sense to people? Any questions?
None have popped up.
Okay. All right. So another thing, what you want to do is, if you're looking at a straddle, right, and we're looking at volatility, there are certain things that can make the stock potentially move, like an event, We talked about earnings, maybe a company event like a conference call. I'm sorry, like a investor call. Maybe they're going to attend and introduce new services or products. So there are other things that could potentially be a catalyst for a move, and you want to try to compile that information and take that into consideration as well, right? So we're looking at it from a historical standpoint, but if there's something that you could detect that could be a potential reason for a catalyst move, you need to take that into consideration, right? So here, I'm just going to come back here. And if you hover over, like, for example, in NVIDIA, there are a couple things here. Company event, right? So on December 9th, I'm seeing a company event coming up, Deutsche Bank's virtual auto tech conference. And then there are market economic events that could make it potentially move as well that will cover this expiration. You got a list there: consumer price index, retail sales, FOMC meeting, so a bunch of potentially major economic events, that could make the market move. And if the market moves, it could be sensitive to the market. And then there's company specific events. And those are things that when we detected, we listed here, it's impossible to know every single event potential, but we do our hardest, to compile that information ourselves. And, we subscribe to feeds that we pay for to also help us out. But that's important as well, to kind of be aware of the known, at least, or published events that can serve as a catalyst to the stock. So we're coming up, actually, up to 9:30.
Yeah, we did have one question from Chris that popped up. He says, do you look at the skew when you're the skew in the market when you're looking at the straddles?
Well, the straddle, not for the straddle. So the straddle itself is not a skew play, because you're actually just you're buying right at the money, right? So it's really just a volatility play if it's going to move away from where the stock price is now. The skew is a little bit different, where it's one option that's out of the money, relative to another option out of the money, like, for example, a 25 delta call versus 25 delta put. And the skew, I could come back to the options chain. When you're doing it on the same strike, the straddles on the same strike, you're buying both, or selling both. A skew is more of, let's come down here. This is more of like when you're comparing one strike, like say the 155 put has an implied volatility of, let's say around 32. And if I'm comparing it to, like, let's say another strike, 180, I can compare it to the put or the call. This has a volatility of around 27.7, right? So here I could see that this implied vol is lower than this implied vol. So there's a skew, right? That means on a relative basis, there's more premium, right? More premium in this option relative to this option. And that could be the case. That's normal for this stock, right? That could be the case that's normal for this stock. And if I wanted to just see how this skew, right, I'm going to run it, right? If I wanted to see how this skew, if I'm buying this call, 180 call, selling the 155 put, I could see that, well, I'm buying a 27.8 vol, selling a 32.1 vol. If I'm doing that, how does that compare to historical levels? So here, I can compare the skew this way and see, well, on average, if I took the average skew, right, in the last 4 years, and this is looking at it dynamically, so it's taking other things out, like earnings, if there's no earnings and so forth. On average, that strategy is 78 cents, right? Historical average 78 cents. So if I'm paying a $1.16 right now, it's above the average. So right now that skew is above the average, and I could see here the range, historical range from 11 cents to $1.82. So that's a way to compare skew. But for a straddle, the straddle is straight, same strike, right? You're not doing different strikes. So skew could be a vertical skew, different strikes within the same expiration, or a horizontal skew that are options at different expirations. So hopefully it helps how to look at those.
Super helpful, D. Thanks so much. I did get a couple questions. Actually, we had a bunch of people pop over to the Zoom, and
Okay.
so I missed. Someone was asking about the IBKR webinar next week, and they were also asking about it in the YouTube chat. So I put the link to the webinar. You need to register for it, so it's there.
Right.
And we'll remind you the day before, but it is next Tuesday at 2 p.m.
Right.
Other than that, D, anything else to say to the chameleons on the way out the door?
No, I mean, thank you for joining. Stay safe out there, everyone. Have a good trading day. Hope to see you guys tomorrow. That Interactive Brokers webinar will be on the options chain. So some of what we're discussing today, that's what I'm going to do deeper. It's a free webinar, but you have to register for it to get into that webinar.
Excellent. And Rob asked about the email he sent yesterday. Rob, we did get that email. I'll talk to Dimitri again about it after the show, and maybe we'll try to present next week something on that topic. Everyone, thank you so much. Dima, great job as always. We'll talk to you later.